Bitcoin, once hailed as the revolutionary digital currency destined to reshape the global financial system, is now facing unprecedented challenges. Over the past decade, it has captured the imagination of investors, tech enthusiasts, and even entire governments. But recent trends suggest that the era of Bitcoin dominance might be nearing its end. Experts in finance, economics, and blockchain technology have started issuing warnings. Bitcoin could die sooner than many expect. So why is Bitcoin under such severe pressure? The reasons are multifaceted, spanning regulatory challenges, market volatility, technological limitations, and environmental concerns. Governments around the world are cracking down on cryptocurrency, introducing strict regulations to prevent illegal activities like money laundering, fraud, and tax evasion. Countries like China have already banned cryptocurrency trading entirely, while the US and EU are moving toward stricter oversight. Such regulatory pressure threatens Bitcoin's adoption as a mainstream currency. Market instability is another critical factor. Bitcoin has always been highly volatile, with prices swinging wildly within days or even hours. While some investors view this as an opportunity for quick profits, others see it as a major red flag. The introduction of alternative cryptocurrencies and blockchain solutions offering faster transaction speeds and lower energy costs has intensified competition, putting Bitcoin's supremacy at risk. Technologically, Bitcoin faces fundamental limitations. The network can only process about 7 transactions per second, compared to tens of thousands for modern payment networks like Visa or emerging blockchain platforms. As transaction fees rise during peak demand, Bitcoin's usability as a daily currency diminishes. Meanwhile, environmental concerns related to Bitcoin mining continue to mount. The energy consumption required to maintain the network is staggering, leading to criticism from environmental groups and governments alike. Given these combined pressures, many analysts are beginning to question whether Bitcoin will survive in the long term. The key takeaway is clear: if Bitcoin's decline is real, investors and cryptocurrency enthusiasts must prepare now. The next sections of this article will explore practical strategies, risk management approaches, and alternative investments to safeguard wealth in a post-Bitcoin world. Part 3: How to protect your wealth if Bitcoin collapses. If the warning signs of Bitcoin's decline are anything to go by, acting proactively is essential. Investors and cryptocurrency enthusiasts need a strategic plan to protect their wealth and minimize losses in case the Bitcoin bubble bursts. Here are the most practical steps you can take. 1. Diversify your investments. One of the most fundamental rules of finance is diversification. Relying entirely on Bitcoin or any single cryptocurrency is extremely risky. By spreading your investments across multiple asset stocks, bonds, real estate, and alternative cryptocurrencies, you reduce the potential impact of Bitcoin's collapse. Diversification is not a guarantee against loss, but it significantly mitigates the risk of total financial devastation. 2. Gradually reduce Bitcoin exposure. Panic selling is rarely the answer, but gradually reducing your Bitcoin holdings can be a smart strategy. Consider reallocating a portion of your investment into more stable assets such as government bonds, high-performing stocks, or precious metals like gold and silver. Selling gradually allows you to lock in profits or minimize losses while avoiding the chaos of sudden market drops. 3. Move funds to stable. If you want to stay within the crypto ecosystem but reduce exposure to volatility, stablecoins like USDT, USDC, or DAIR, viable options. These cryptocurrencies are pegged to traditional fiat currencies, providing relative stability compared to Bitcoin. Stablecoins can act as a temporary safe harbor while you plan your next financial move. 4. Focus on long-term, tangible assets. Bitcoin's appeal has always been its potential for massive short-term gains. However, tangible assets such as real estate, precious metals, and dividend-generating stocks provide long-term stability. By investing in these assets, you protect your wealth from the wild swings and speculative risks inherent in cryptocurrency markets. 5. Stay informed and monitor the market. Knowledge is power, especially in a rapidly evolving financial landscape. Stay updated on Bitcoin-related news, regulatory changes, and market trends. Watch for early signs of systemic issues, such as major exchanges, freezing withdrawals, or government crackdowns. Being informed allows you to act decisively rather than reactively. 6. Consider professional financial advice. If your Bitcoin holdings are significant, consulting a financial advisor with experience in cryptocurrency can be invaluable. They can help you develop a personalized strategy, evaluate alternative investments, and navigate tax implications of selling or converting assets. A professional perspective can help you avoid costly mistakes during turbulent times. By taking these proactive measures, you can safeguard your financial future even if Bitcoin collapses entirely. The next section will discuss potential opportunities in a post-Bitcoin world, how to pivot, invest wisely, and even benefit from the decline of the cryptocurrency giant. Part 2. Signs: Bitcoin may be on the brink of collapse. If you've been watching the cryptocurrency markets closely, there are several red flags indicating that Bitcoin may be approaching a critical tipping point. Recognizing these signs early is essential for anyone who wants to protect their investments and make strategic decisions before it is too late. 1. Extreme market volatility. Bitcoin has always been volatile, but recent fluctuations have reached levels that even seasoned investors find alarming. Sharp price drops followed by speculative spikes create an unstable market environment. For example, in recent months, Bitcoin has swung by over 20% in a single week, multiple times. Such extreme volatility undermines confidence in its value as a stable store of wealth or medium of exchange. 2. Declining institutional interest early in its rise. Bitcoin attracted major institutional investors, from hedge funds to publicly traded companies. However, recent reports suggest a slowdown in corporate adoption. Some companies that previously held Bitcoin reserves have begun divesting, citing market instability and regulatory uncertainty. A decline in institutional support could trigger a broader loss of confidence in Bitcoin's long-term viability. 3. Regulatory crackdowns. Governments around the globe are tightening controls on crypto. From banning mining operations to imposing strict tax regulations on trading, authorities are making it increasingly difficult for Bitcoin to operate as an unrestricted currency. Regulatory actions in major markets like the United States, China, and the European Union could further erode its legitimacy and appeal. For emergence of superior alternatives. Bitcoin was the first cryptocurrency, but it is no longer the most efficient or environmentally friendly option. Alternatives like Ethereum, Solana, and Cardano offer faster transaction speeds, lower fees, and advanced smart contract functionality. As investors and developers migrate to these platforms, Bitcoin's network dominance may decline, further weakening its position in the market. 5. Environmental and energy concerns. Bitcoin mining consumes enormous amounts of energy. Recent studies have compared its energy footprint to that of entire small countries. With global attention on climate change, environmental criticisms are intensifying. Governments and institutions are increasingly reluctant to support a network that contributes so heavily to carbon emissions, potentially leading to bans or limitations on mining operations. 6. Public sentiment shifts. Finally, public perception plays a huge role in Bitcoin's survival. Social media trends, news coverage, and online sentiment analyses show growing skepticism. As more people question its utility and legitimacy, the potential for a mass sell-off increases. Public confidence is critical for Bitcoin. Without it, the network could experience rapid devaluation. These signs collectively indicate that Bitcoin may be approaching a precarious point. Investors should take these warnings seriously and consider strategies to mitigate potential losses. In the next part, we'll explore what you should do if Bitcoin truly begins to collapse and how to safeguard your wealth. Part 4. Opportunities in a post-Bitcoin world. While Bitcoin's potential collapse may seem alarming, history shows that financial crises often create opportunities for those who are prepared. By understanding emerging trends and alternative investments, you can position yourself to benefit even if Bitcoin fails. 1. Invest in emerging crypto. Not all cryptocurrencies are doomed. Many newer blockchain projects offer advanced features such as faster transaction speeds, lower fees, and energy-efficient consensus mechanisms. Ethereum, Solana, Cardano, and Polkadot are examples of networks gaining traction among developers and investors. Shifting some of your crypto holdings to these platforms could provide growth potential without the same risks associated with Bitcoin. 2. Explore blockchain technology beyond currency. Bitcoin is just one application of blockchain. Many industries are adopting blockchain solutions for supply chain management, healthcare, finance, and digital identity verification. Investing in companies and projects leveraging blockchain technology rather than the currency itself can provide exposure to the crypto ecosystem with lower risk. 3. Precious metals and hard assets during financial uncertainty. Tangible assets like gold, silver, and real estate often outperform volatile investments. These assets have intrinsic value and are less susceptible to rapid devaluation. Shifting part of your portfolio into these hard assets can act as a hedge against Bitcoin-related losses and provide long-term security. For stocks and exchange-traded funds, ETFs. The stock market continues to offer opportunities for growth, particularly in tech, renewable energy, and emerging industries. Additionally, ETFs that focus on blockchain technology or diversified asset classes allow investors to gain exposure without the extreme volatility of Bitcoin. Carefully selected stocks and ETFs can provide consistent returns while balancing risk. 5. Alternative investments. Beyond traditional markets, alternative investments such as venture capital, private equity, or cryptocurrency mining ventures can provide opportunities for diversification. These investments often have higher entry barriers but can yield substantial returns if chosen wisely. Remember, due diligence is critical. Avoid high-risk schemes promising unrealistic profits. 6. Education and skill development. Finally, one of the most underrated strategies is investing in yourself. Cryptocurrency markets are volatile, and those with knowledge, technical skills, and financial literacy are better equipped to navigate uncertainty. Learning blockchain development, financial analysis, or digital asset management can position you for future opportunities regardless of Bitcoin's fate. By shifting your focus from a single cryptocurrency to diversified assets and skills, you can turn Bitcoin's potential collapse into a strategic advantage. The final part of this article will focus on actionable steps to maintain financial resilience and mindset strategies for navigating uncertain markets. Part 5. Staying resilient and thriving if Bitcoin collapses. The potential collapse of Bitcoin is not just a financial concern, it's also a test of preparedness, mindset, and adaptability. While the warnings are serious, investors who act wisely can protect their wealth and even seize new opportunities. Here's how to navigate this uncertain future. 1. Accept uncertainty. The first step in financial resilience is accepting that uncertainty is inevitable. Cryptocurrency markets are inherently volatile, and no one can predict the future with complete accuracy. Instead of panicking or waiting for a guaranteed outcome, focus on creating a strategy that protects your assets under various scenarios. 2. Have a contingency plan. Develop a clear contingency plan outlining what actions you will take if Bitcoin's value drops dramatically. This plan might include steps such as liquidating a portion of your holdings, reallocating funds into stablecoins or tangible assets, and monitoring regulatory changes that could impact your investments. Having a plan reduces emotional decision-making during market turbulence. 3. Maintain liquidity. Liquidity is crucial during times of financial instability. Keep a portion of your assets in cash or highly liquid instruments so you can react quickly to market shifts or seize opportunities without being forced to sell at a loss. Liquidity ensures flexibility, giving you options rather than constraints. 4. Avoid herd mentality. One of the biggest risks during a potential Bitcoin collapse is following the crowd. Social media hype, fear-driven selling, and speculative rumors can lead to poor decision-making. Base your investment choices on careful analysis, verified information, and your long-term financial goals, rather than public panic or euphoria. 5. Reassess your risk tolerance. Bitcoin may no longer fit every investor's risk profile. Reassessing your personal tolerance for volatility and potential loss is essential. If Bitcoin's high-risk nature causes undue stress, it may be wise to reduce exposure or transition to safer investments. Protecting your mental and emotional well-being is just as important as protecting your financial assets. 6. Keep learning and adapting. The cryptocurrency landscape is rapidly evolving. Even if Bitcoin declines, new technologies, investment opportunities, and financial instruments will continue to emerge. Stay informed, update your strategies, and adapt to changes. Continuous learning allows you to turn challenges into opportunities. 7. Focus on long-term wealth building. Finally, prioritize long-term wealth over short-term gains. Diversified investments, tangible assets, skill development, and strategic planning create a resilient financial foundation that can withstand market shocks. By focusing on sustainability rather than speculation, you reduce dependence on any single asset, including Bitcoin. Conclusion: Bitcoin's potential decline is a wake-up call for investors and cryptocurrency enthusiasts alike. While the digital currency may face severe challenges from regulatory pressures to technological limitations, those who act prudently can safeguard their wealth and even benefit from emerging opportunities. Diversification, liquidity, continuous learning, and emotional discipline are key. By preparing for the worst while staying adaptable, you can survive Bitcoin's collapse and thrive in the evolving financial landscape.